Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Let's talk to Ira Jersey here, Chief U.S. Interest Rate Strategist. Ira, I just saw
thank God.
Michael McKee leaving here. He's going to hop on the Acela train, get down to Washington, D.C. for that Fed meeting tomorrow, where he can heckle the chairman with some questions. What do you want to hear from Fed Chairman Jay Powell tomorrow after the release of the results there?
Well, what I'd like to hear and what we're not going to hear is going to wind up being what's the Fed's reaction function and for when they might cut or raise interest rates. Obviously, if inflation accelerates meaningfully, they'll raise interest rates again. They've already mentioned that they might have to do more if inflation does accelerate, although we got some data today that seems like maybe it is going to moderate a little bit. But really, what will it take for them to cut? And I think that the idea that they're going to remain at the peak for some time, which they've hounded on, it would be helpful for them, I think, to basically be a little bit more explicit. Like, look, we're not cutting unless the unemployment rate is, 3-4 percentage points higher than where it is, and inflation is close to our target, right? So saying something like that, which isn't completely explicit, but it still has some meaning around it for markets. I think that would be helpful for the Fed to maintain monetary policy at this pace.
Close to our target is weak talk.
Weak talk?
Weak sauce, right? I mean,
do you want a hawkish?
Why don't they say, we want to get to 2%, to our target, at least for 6 months or a year. Weren't they trying to long-term average 2%? And how many decades would that take?
Yeah, well, that was their old framework. It wouldn't take that long because remember we were at under 2% at least for quite a while in the last decade. I think the thing for the Fed though is that if inflation is 2.7%, 2.6%, 2.5% trending lower, and you had a real spike in unemployment, then everyone would be forecasting inflation to be significantly lower, right? And I think that's the reason why they can say near our target or approaching our target, right? Something like that. So the Fed doesn't like to be as explicit as saying, look, we will cut interest rates if the unemployment rate is above 5% and inflation is at 2%. If they won't be as explicit as that because they want to leave themselves flexibility in case there's a crisis, if there's massive corporate defaults, for example, and unemployment spikes, but you still have year-over-year inflation hasn't fallen off a cliff yet. They always want to leave some of that flexibility. But what's interesting about the Fed is it's that little minutia and detail that's going to matter because the Fed's probably not going to do anything tomorrow. The Treasury Department, though, at 8:30 in the morning is going to give us some information that might actually be market moving.
So, yesterday we heard from, Treasury that they need about, $800 billion in this quarter?
$776 billion, right, in this quarter of net debt raise, effectively. That's a little bit higher than what our expectation was, a little bit lower than most expectations, and the reason is that they want to keep this pretty big cash balance. They want to keep a cash balance of around $750 billion. So in order to do that, with Social Security payments coming and additional payments for Medicare, as well as just general government deficits, not to mention interest payments on the debt, they're going to have to raise quite a lot of money. Now, interestingly, remember that $776 billion is what they're selling to the public. It's actually not the total debt that's being raised because there's non-marketable debt, so debt from the Social Security Trust Fund and some other trust funds that are being paid down. So what you'll see is a deficit for the quarter of around half a trillion dollars, around $500 billion. But the actual debt that they need to raise is much more than that because of the things that we've known for 30 years, right? The Social Security Trust Fund is a net negative, and that has to be funded out of general revenue. So it's all the problems that we've seen over the last 25 years, and we said were going to be problems for the government debt, are actually coming home to roost right now.
So Ira, nobody likes to ignore Treasury auctions more than me, but you tell me I now have to pay attention to this?
Well, they've been important. They've been market-moving events. When you look at auction demand, the last couple of weeks, they've started to slip a little bit on average. Last week, for example, we had pretty weak auctions for 2-year debt and 5-year notes, but the 7-year on Thursday went okay. But I would say that demand is much more mixed. Prior to this past month or so, we actually had pretty decent demand at auctions. People were, I think, were taking advantage of the sell-off. We, hit 5% on 10-year notes, and people had, taking a little stab at maybe owning a little bit more at auction. So yeah, we need to see if demand is maintained, particularly since tomorrow morning, with all of that $700 billion of debt that needs to be raised, there's going to have to the government's going to have to increase the size of auctions almost across the board.
So I'm looking at the 210s. That's another thing you got me looking at, unfortunately. Still inverted, but much less than it was before. Now only about 20 basis points or so. Are we going to get to a point where we actually have longer-term yields higher than shorter-term yields?
Yeah, I think we will, and it will probably happen early next year. I think it really depends, though. The important nuance of that is it because 2-year yields go down a lot? So do we have a weakening economy? Is Anna Wong and the Bloomberg economics team correct? And if we do have a meaningful slowdown in the economy, we could probably see 2-year yields go down 25, 50 basis points, and 10-year yields go down less than that. And that's how you wind up getting that positively sloped yield curve. On the other side, if the economy stays reasonably robust, but only because we have all of this debt issuance, you could see 10-year yields maybe up above 5%, up to 5.25, 5.3%, and that could uninvert the yield curve, and that would not surprise me at all. In fact, we actually think that we are in the process of completely uninverting, and we do expect to see a positively sloped yield curve sometime over the next 12 months.
You raised an interesting point that Treasury Secretary Janet Yellen last week, she said the reason we have high yields is not to do with the debt and deficits, nothing to do with that. Look away from there. Don't look there. It's because of the strength of the economy, because of Bidenomics, from the middle out, from the, what is it? Middle out and I can't remember.
Belly, you mean?
He says he has a catchphrase that he uses. Bottom up and middle out. That's what it is. So is that the case? And will we know from the refunding how much of the rise in yields is due to the high debt and deficits, and how much of it is due to the speeding economy?
Yeah, these are only things that can be estimated, but our estimate is that around 92% of the move from the July Fed meeting to present in the 10-year yield has been due to the shift in Fed expectations. And so if you go and you look at what the expectation is that the market's been pricing, we were pricing for 2.5% Fed funds rate in 2025. We're now pricing for 4% in 2025. So that's a huge move, right? I'm talking about a 150 basis point move up in where the Fed is going to cut to, or where the market thinks it's going to cut to. So that had to manifest itself all throughout the Treasury curve, and in particular in the longer end, because the longer end was anticipating rates to be much lower and policy rates to be much lower a few years from now. So I think the debt dynamics do have some effect, and they certainly have effect on liquidity. But
all right,
really
we're going to just leave it there, but we appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Caterpillar. They make the big tractors and all that kind of good stuff, backhoes. They reported some numbers today which were in line, I guess pretty solid, but it's all about the outlook for these long cycle industrial companies, and that's what's got some investors spooked here. As John mentioned, the stock's down about 5% here today. Let's break it down with the man who knows what's happening with this company, Chris Ciolino. He covers the big industrial companies for Bloomberg Intelligence. He's located down in Princeton, New Jersey, the HQ, if you will, of Bloomberg Intelligence. Hey, Chris, talk to us about Caterpillar. You've been calling out, I know in the last few quarters we've been speaking to you about, boy, these companies are putting up great numbers, but investors are really looking forward and they're a little bit concerned. That seemed to come to fruition here today. What'd you see?
Yeah, I mean, to your point, I mean, the quarter was fine. Actually, it was quite good with better than expected margin performance and earnings. Pricing continues to be really strong, but what we saw was a pretty broad deterioration when it comes to their leading indicators. Backlog fell for the first time in 3 years. Implied orders also dropped sequentially and year over year. And their fourth quarter sales outlook was somewhat kind of disappointing and below normal seasonality and consensus. And there was a fair amount of trepidation about the macro backdrop heading into the print. And I think these softer orders and backlog trends that we saw aren't necessarily encouraging and what is likely to be a softer economic environment next year, and really just kind of intensify some of those concerns around the duration of the cycle.
Yeah, so we saw the year-on-year decline of $1.9 billion in the backlog. What exactly does that mean? Does that mean, exactly what I think it does, that they had orders that were that much lower? I mean, how much was the backlog in total?
Yeah, so I would say the moderation in the backlog wasn't necessarily a surprise, and I think it was somewhat to be expected, just given normalizing supply chains and some of the lead time shrinking with some of the product availability. But I think the magnitude of the decline was kind of what spooked people, particularly on the order front. Orders were down about 15% versus the prior year and 20% sequentially. So I think that sheer magnitude and just the optics of
But what's the magnitude of is a $1.9 billion drop a 10% drop in the backlog, or is it a 50% drop in the backlog?
No, it's an 8.5% decline sequentially. So but it's the first time we've seen backlog's essentially peaked. This is the first time we've seen it
sequentially. So you're not talking about the year-over-year drop.
Yeah.
Right.
That's I can see how that would spook people. What's Cat saying about are there any particular customer segments that are maybe weaker than expected? What are they saying about kind of where this might be coming from?
Yeah, I think I'll actually maybe start on the construction side. I think that was one positive surprise, particularly in North America. North America continues to be quite resilient, and end user demand continues to be pretty strong, really across their business. The energy and transportation business came in a little bit weaker than we had anticipated, and there was some softness on the mining side on the top line. It seems to be some timing issues, but also there was some weakness in the aftermarket business, which was a little surprising just given the age of the fleet, and utilization still remains quite high. So those bear kind of watching going forward here.
So give us a sense of a cycle here for like a Caterpillar. I mean, you said this is the first time in 3 years they've had down orders sequentially. That sounds like a pretty good cycle, but are down cycles similarly like in length?
No, as much as we like to think every cycle is the same, they tend to be different. And I would say, even though backlog had peaked here, we are still at historically very elevated levels, and there is really above average production visibility as we look forward to next year. But the optics are, you have a cyclical company with declining orders, a declining backlog. It doesn't, just the optics of that are not a favorable setup for the company moving into next year.
How about the Inflation Reduction Act? Isn't that like lots of Caterpillar type stuff you need?
So it is, and I guess one of the caveats with this cycle is it's different because we just have an immense amount of fiscal stimulus coming through the pipe, and I'd say a lot of that has really kind of yet to materialize into the financial results of a lot of these companies, and it's part of what's propping up the backlog here. So I think that does help provide an offset. I think some of the decline is certainly attributable to the normalizing supply chain and shrinking lead time. So maybe a little bit of an overreaction, but this will certainly provide a multi-year tailwind for the company, and really probably provides a little bit more of a favorable outlook for a lot of the construction machinery producers relative to some of the other machinery end markets.
What are the biggest competitors, and do they face a threat there? I mean, I look through all the names on the RV page on the Bloomberg, and I don't see anything that really stands out as, a household name other than maybe Mitsubishi. But, who are they facing off against?
Yeah, so they're the undisputed leader in the construction machinery space. When it comes to mining, it's essentially a duopoly with them and Komatsu. And Komatsu's a pretty significant player on the construction side as well. everyone else tends to be subscale. They do compete with Deere also on construction. They're starting to grow their construction business, so I would expect them to be a more formidable competitor in the years to come. But really, it's Cat and Komatsu. Those are the dominant forces in the market.
How about geographies, Chris? Particularly China. What's their exposure to China, and what are they saying about China?
China's weak and continues to weaken. Really no signs of a turnaround yet. So, historically, China's been roughly 5 to 10% of consolidated sales at Caterpillar. This year, we're going to be well below the 5%, and the lowest in quite some time. Not really hearing any sort of optimism coming out of that region.
And how about Europe? Because I know I can see here on the PGEO page, that's EAME is about 20% of revenue. What are they seeing out of Europe? Because I know people are concerned about that, those economies over there.
Yeah, and that actually held up a little better than I had anticipated. We're just starting to hear this earnings season from a number of other machinery producers that there had been some weakening in the sentiment over in Europe and even some softer orders. Didn't really get that coming out of Cat, and some of their retail sales trends didn't seem to suggest a significant deterioration there yet. So again, another item worth kind of monitoring moving forward.
We just saw the Eurostat growth figures, by the way, Paul.
Yeah.
So the European economy contracted 0.1% in the third quarter, and we were looking for just a stagnation. So it's getting smaller there. I guess consumer prices are coming down, which is good. They got a 2 handle on them, 2.9% in October. Yeah.
Hey, Chris, just looking ahead a little bit, my good friends at John Deere, the nice green tractors, are reporting in a few weeks here. And, I always love to look at the Deere results because it gives you a great handle on kind of how the state of the farmer out there. How are things at Deere?
So I think Deere is going to have a more challenging setup into 2024 relative to Cat. We think the ag market has already peaked, so we're kind of anticipating single-digit volume declines next year. Now, remember, Deere will report their fiscal 4Q results later in November, so they'll provide the kind of first look at 2024, but we're certainly expecting a lower volume market on the ag side. We're coming off a number of strong years, but you're starting to see commodity prices, row crop soften quite a bit. Farmer income is going to be down 25% this year, so
really?
I'd say a less favorable outlook on the ag side in 2024.
And the farmer, when the farmer has cash, he or she goes out and buys tractors and stuff like that. But it's a cyclical business, so the flip side is true, right?
Yeah, and the magnitude numbers sound pretty draconian, but I think we'll still be second or third highest all time in terms of net farm income. So we'll be down from a peak in 2022. It's still going to be historically strong, but I would just expect farmers to dial back some of the spending, just given what's going on with some of the farm fundamentals and again the weaker crop prices that we've seen.
All right, great stuff. I'm just looking at Deere right now. The stock's off about 15% year to date. So there's the market discounting a good 12 to 18 months in the future on that name. Chris Ciolino, we always appreciate getting a few minutes of his time. He's the industrials analyst at Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Looking at INGO, that is the Bloomberg Index browser, kind of gives you the performance year to date, month to date of all the big indexes out there. And for the fixed income space in the U.S., it is red with one exception. U.S. corporate high yield up 4.38%. Why is that? Let's check in with our next guest, Ken Monaghan, co-director of high yield at Amundi US. He's based in Durham, North Carolina, but up here in New York. Ken, 2022, as we've talked about before, was the mother of all disasters for fixed income investors. This year's not much better through the first 9-10 months. What's going on in the corporate high yield market? Why is that showing some positive returns?
Well, you're right, Paul. I think it's been a reasonable year considering how bad we've had it in the past, and it's a decent year, and it's a year where risk is outperformed. Now, October thus far has been miserable for risk, but if you're looking at the year to date, we see the triple C credits are up, really about threefold what double Bs are. So we've had a fair amount of spread compression.
So, but I mean, everybody's been telling Matt and I that we're going to have a recession any day now. If that's the case, why are people taking incremental risk that they do when they go into the high space?
I mean, if you're paying me, I get it. But if you're not paying me, why am I buying it?
Well, if you look at spreads where they are right now, arguably they're only at the 5 and 10 year averages, so they're not looking particularly cheap. On the other hand, that the economy's done pretty well, and I think that that's really what's been driving spreads. Is we'd all been waiting or expecting a recession, whether it was in the later half of the early part of the first half of the year, or then the back half of this year, and then people are forecasting it for early 2024. And thus far, the economy continued to power through, and I think that's what's been driving spreads.
But aren't you worried that defaults are going to start to pick up?
Well, interestingly enough, if you look at the Moody's estimates, they're expecting defaults will peak sometime in the spring of next year, but at a fairly reasonable rate. But let's remember, when Moody's puts out its numbers, it is an unweighted number. So they count a $100 million default the same way they count a $1 billion default. If you look at it on a adjusted basis, where they're using weightings based on the amount of debt outstanding, the default rate for this year is still running under 2%. Now, they're expecting the default rate to rise into the mid to high 4s, but that's a pretty big differential. So what it tells us is the companies that are getting into more difficulty tend to be smaller companies rather than larger ones at this point.
What's the new issue market like? I used to love throwing out some high yield for my clients back in the day because I love the media cable paper. What's the new issue market like these days?
It's pretty soft right now, not surprisingly. I think we had a pretty robust calendar coming into September, and that there were a number of companies that had financings, whether it was M&A related or LBO related, that needed to get done, and they got those done. But since then, obviously, treasuries have risen fairly dramatically.
Yep.
And then on the back of the 50 beeps treasury move we've had in the last 4 or 5 weeks, we've had about a 75 basis point widening of high yield. So I think companies have taken a step back and said, let's wait a minute here. Let's hope that spreads get tighter, or hope that treasury rates come down and moderate, and we'll find a better financing opportunity. Now, the problem with that from our perspective is if you wait too long and we are right, and we do see more of an economic slowdown in 2024, which is what our expectation is, that would imply, as you're suggesting, that spreads ought to be wider, not tighter. And if spreads are not wider, then the Fed's likely to keep its foot on the brake pretty hard, because that says the economy's powering along too strongly, and they're going to have to react.
Right. So, or else you're playing along too much. You need to get a little bit more vigilante, don't you? What can you do, by the way, in terms of pivoting your strategy? Can you go up in quality if you're co-director of high yield?
Sure, yeah, and we've been doing a fair amount of that. And I think then the other thing you do is you go into sectors where you have a greater degree of certainty. So, we look, affluent consumers are still spending. Cruise ship companies happen to be doing extremely well. And actually, if you look at their bookings through 2024, they're solidly booked. We've seen some softness in the airline space, but the cruise ships happen to be different. Even if you're looking at something like home builders, you would say to yourself, well, how could home builders be doing well in this kind of environment? Well, right now, secondary or home sales have dried up, because anyone that's got a 3.5% mortgage or a 4% mortgage isn't going to sell their house and buy something new unless they absolutely have to, because they're moving, for example, to a whole other state. So the only game in town right now is buying a new house. And the margins on the home building industry over the last several years have accelerated in a significant way. So they've got room to play around and offer extra financing support for the first 2 or 3 years. They can bring down the quality, or put carpeting in instead of hardwood floors. They've got room to maneuver, but the home builders are actually doing quite well.
How about in the cable/telecom space? Big issuers in the high yield space historically. How are those? Are you guys have exposure there, and what do you like or don't like?
We do. The cable sector. If we look back and you look at some of the names in the space on the equity side over the last couple of years, they've been under pressure.
Yeah, big time.
And I think that's reflecting a couple of things. And one is the competitiveness of wireless alternatives.
Yep.
And then there was cord cutting is obviously going on. But I think we've seen some changes in the last several months.
But they always pay their interest in principal, though.
Yeah, they are always paying their interest in principal. And I think, think about how many of us are still working from home at least part-time, maybe not in the office every day of the week. And those people need broadband access.
What's the average office professional in Durham, North Carolina. What are they doing? How many days a week back in the office?
I'm going to say we're in at least 3 days a week. And I'm going to say that's what most people are doing.
See, that's the new normal, man.
Yeah. No, I know it's
You
the
go out
new
in the
normal.
real world, that's what the real people are doing.
Well, I think bosses are trying to change that,
Yeah.
but employees are fighting back.
Yeah, we just need a good recession. All right, real quick, what do you expect from your Federal Reserve tomorrow?
I think it's going to be a quiet day from the Fed. I think that there's reasons why they may go the other way and raise rates, but I don't think that that's in the cards right now. I think we're in a holding pattern.
All right. Again, looking at the IN function, the Bloomberg Index browser, U.S. mortgage-backed securities, U.S. aggregate, U.S. government credit, U.S. Treasury, U.S. universal, all down 2.34% year to date. The one exception, U.S. corporate high yield up positive 4.38% return. But as you mentioned, Ken, on the month, down 1.4%. All the bonds.
Yeah, if you look at JNK or HYG, they're not doing that great.
Yeah, yeah. So interesting stuff there.
But positive for the year.
But positive for the year. And on Friday, we'll talk with Joe Misek, talked about the municipal bond market.
I'm very much looking forward to that. Yeah.
Ken Monaghan, thank you so much for joining us. Ken Monaghan, co-director of High Yield for Amundi US, based in Durham, North Carolina.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
We're right smack in the middle of earnings. Markets digesting them on a daily basis. Got some more earnings after the close today. AMD, then of course Apple after the close. We want to go across the pond and see how things are over in Europe with earnings, with markets. Where's the performance? Where's the risk? And we do that with one Tim Craighead. He is the director of research, and he's also a senior European strategist for Bloomberg Intelligence, joining us from Queen Victoria Street, the European global headquarters of Bloomberg, and it is a smoking hot building, just crazy, the building over there. Hey, Tim, thanks so much for joining us here. Give us the headlines. Just step back 30,000 feet for our listeners and viewers who maybe aren't really up to date on how the European markets have been performing this year.
Yeah, well, we have been behind the U.S. from the standpoint of market performance. We don't have the big tech that's driven the S&P 500 back up over the course of into autumn. That said, we also don't have the big tech that's been under pressure since the July-August peaks. And so while the U.S. is certainly taken a pummeling, and we've not sold off as much. So that's sort of the quick synopsis.
So we've taken a pummeling, you've sold off, but not as much. Today we learned, though, that your third quarter showed a contraction in growth, and we were growing 5%, buddy!
Hey, there you go.
No, I'm kidding. Obviously, backward-looking isn't what matters, and as Caterpillar, I think, proves today, people really care about the outlook. As if we didn't know that already. How is the outlook for European earnings compared to U.S. earnings?
So, Matt, I think it's really interesting thinking about the earnings picture. Again, the compare and contrast. The U.S. went through a few quarters of earnings contraction while Europe was still gaining. A lot of that earnings contraction in the U.S. was big tech oriented. And what we're feeling now in Europe, and we will see an earnings decline again this quarter, is actually a lagging impact of the decline that we've seen in things like energy and metals prices, which are really big over here, much more so than they are in U.S. markets. The thing I don't think either market has necessarily felt is the full impact of the spike in interest rates that we've had and how that's going to have an impact on consumer and businesses as we go into 2024, which does play into an awful lot of the earnings commentary that we're hearing through the reporting period. Just to give you a couple of numbers, we're about halfway through here in Europe, a little behind where you are in the U.S. It sounds okay that we've got about 50% of the companies that have beat earnings expectations, about 35 that have missed. But in fact, that's the worst performance from the standpoint of beats versus misses that we've had since the pandemic lows. So I would categorize this as a pretty disappointing earnings season.
Hey, Tim, talk to us about valuation. Where are you guys over there in terms of valuation right now?
Yeah, so you look at the broad European market, we're at 12.5 times forward earnings. It's down from recent highs of 13-ish. Clearly far below where the U.S. trades. You can find markets like the German DAX index that's retraced all the way to 10 times forward earnings, and that's with a heavy dose of the big German auto companies that are facing increasing pricing competition and EV competition from China. So, it's clearly there's a value tilt from the standpoint of an absolute multiple across the European markets. But I'd also say, and it's true from a U.S. perspective as well, with interest rates being as high as they are, and they've certainly ratcheted up here, market by market, over the course of the autumn, that does take a toll on what you're willing to pay in terms of market valuation. So what would seem cheap from an absolute level, 10 times, 12 times a year ago, now isn't quite so cheap on our fair value work because interest rates are simply higher.
Yeah, I wonder how important China is to European earnings. And I know they haven't fully penetrated the entire continent, but when I was over there, they had made their way up through Africa and straight to the tip of Italy. Is it a bigger driver of, let's say revenue growth, China, than it is for U.S. companies?
Significantly so. If the recent analysis we did looking at the stock 600, 80 of the 600 have got overtly easy to define significant contribution. If you add it up, it's about 450 billion in revenue. These companies aggregate to be about 30% of the European market in terms of index weight. So any way you want to cut it, there's a lot of companies, they're big companies, and it's a lot of revenue. And what we're seeing in the third quarter, maybe no surprise given the faltering, stuttering economic growth in China, is that business is also faltering a bit. I already mentioned the German autos as a case in point. Contrast that with Stellantis today, which doesn't have so much China exposure but more U.S. exposure, and it was a little bit better. The luxury good companies have talked about weakening China economic activity, and there are several others that are showing that there are signs of weakness. Now, two things other to mention on China. This was still an easy comparison for 3Q. Remember, they didn't open back up until October and November last year, so it's really the fourth quarter that is going to be a more difficult comparison and on into the first quarter of next year. So if things are still stuttering, that business is going to be more of a challenge. And the other thing, obviously, thinking about 2024, the more pressure there is on the economy, the more likely there's going to be fiscal and monetary measures to stimulate the economy, which might all of a sudden turn this around as we look into the back half of next year. And clearly the markets will discount that. Right now, everybody's focused on current weakness. That may be short-lived.
Hey, Tim, you travel all around the continent, all around Europe, speaking to institutional investors. What do they want to know? I mean, what's kind of the common question, top question you get asked?
Yeah, Paul, I guess a couple things come to mind. I was just in an event last week in Frankfurt, and at this point, it really is all about the macro outlook and what's going on with monetary policy. When is the pivot going to happen, and how much of that pivot does then translate into a reduction in things like 10-year yields, because it's not an immediate feed through. But that's crucial, because the higher we are, the longer we are on interest rates, the more of an impact there is on business and consumer, and that's a huge pressure point for the 2024 outlook.
All right, in suburban London, near your pad, what's a good pint going to cost me?
A good pint when I go for Halloween today, Paul.
There we go. Thank you very much.
Is going to be about £7 for a pint.
Wow, £7. And do you do like Guinness extra cold, or do you have them pull you an actual ale from one of those old school taps?
I like the cask ales, definitely.
See?
Old school.
Yeah, delicious.
And
best thing is a Trappist ale, though, from Belgium. That's the best beer.
That's the best beer. Hey, are you still avoiding the congestion tax in London by riding your bike to the office?
I do. I rode this morning.
See, he's one of those people that
and I'll ride home this afternoon.
See?
That's smart. I'm going to avoid the congestion charge in New York by getting a garage on 60th Street.
Yeah, we're going to get John Tucker a bike.
Yeah, I'm going to ride my bike
through
at
the Lincoln
2
Tunnel.
o'clock in the morning.
John
That'll
Tucker
work
ride
out
his
really.
bike through the Lincoln Tunnel at 2 o'clock in the morning.
I don't think they allow bikes in the Lincoln Tunnel.
All right, Tim, thanks so much for joining us. As always, appreciate it. Tim Craighead, he is the Director of Research over there in London, and he's the Senior European Strategist for Bloomberg Intelligence. Tons of experience in the equity markets. Morgan Stanley did a little hedge fund work, and then we nabbed him at Bloomberg Intelligence back in the day.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's take a look at these markets. Where do we go from here? We're right smack in the middle of earnings. People starting to think about next year, where to be positioned. Our next guest thinks about that stuff as well. Lukasz Tomicki, he's founder, managing partner of LRT Capital Management. Lukasz, thanks so much for joining us here. Let's start off by just getting a sense of how you guys deploy capital at LRT Capital Management. Kind of what's your strategy that you guys deploy?
Hey, Matt, thanks for having me. Yeah, to give you a quick overview, we're really trying to focus on business quality and business resilience. So to us, quality means three things. It means some kind of durable competitive advantage. It means the ability to grow and reinvest capital at high incremental rates of return. And it means management teams that have demonstrated a good track record of allocating shareholder capital.
All right, so looking at all those variables, what do you like?
Well, I think, from a macro perspective, we're likely heading towards an economic slowdown, if not an outright recession. And so today, the theme for me is really investing in resilient companies. So the three companies that we like most today are Chemed, which is kind of an odd business. They own two businesses within it. We also love Elevance and TriNet.
All right, let's start with Chemed here. Tell me kind of what business they're in. I'm looking at the stock here. It is an $8.5 billion market cap company stock. Stock's up about 10% year to date. So tell us about the call there. What do they do and what's the investment call?
Yeah, so Chemed is a very odd company in that they own two businesses that are completely unrelated to each other. They own Vitas, which is a hospice care provider, and Roto-Rooter, which is a commercial plumbing service.
Yeah, I don't see the connection, but go on.
No, there's no connection on the surface, but the real connection is that these are very resilient businesses from a macroeconomic perspective. So Vitas provides end-of-life care effectively, and Medicare, of course, is the largest customer. And so for most people, the statistics say you're spending somewhere between 25 to 30% of your entire life's healthcare cost just in the last few months. When you're effectively dying in the hospital, getting very expensive care, very expensive treatment. And that's a very big cost for Medicare. And frankly, not everyone sees the benefits of that. So many people opt for hospice care, which is effectively palliative care where you end treatment and you're just receiving medication to manage pain and improve your comfort of life. And obviously that saves costs. And frankly, a lot of people see that as a more dignified way to go. And
just looking at this, Lukasz, you just don't see many corporate structures like this anymore. Just pure holding companies, particularly ones that own just two businesses. What kind of attracted you to the company?
Well, I followed it for a long time, and I don't think I'm the only one. But what frankly attracted me to the company is up until a few years ago, their website looked like it was straight from the 1990s, and that might sound counterintuitive, but that was to me a very odd signal that this is a company that's really focused on business operations and not promoting things. And so, generally speaking, we like non-promotional, down-to-earth kind of management teams.
And it's up 87% over the past 5 years, up 10% this year, 87% over the past 5 years total return. It's done well. The Roto-Rooter business also, these are two businesses that people are never going to not need, if I can split my infinitive just to make the point. And I get that. Do they spin off at some point, one or the other? Do they break into two, do you think?
I think that's long been the theme and the thinking. I frankly don't have a problem with the business the way it is. They have opportunities to deploy capital, primarily in the Roto-Rooter business, by buying out franchisees from some of their territories. And then they have opportunities to buy back stock when the shares are trading down. And as you mentioned, the stock is up a little bit this year, but that's largely happened last week on the back of good earnings. So, you're going to have ups and downs, but it's a very resilient business. They've grown about 4% per year in terms of revenue, but they managed to translate that into a 14% EPS growth over the same, last 10 years or so.
All right. How about ELV, Elevance Health, another healthcare name?
Yeah, so this is Elevance. This is the former Anthem insurance business.
I know that.
So you may have heard of it as Anthem. They rebranded themselves. We love the industry, broadly speaking, the health insurance industry. It's a very consolidated business. There's 5 players that command the majority of the market, a couple smaller ones. And, this company is called a health insurance company, but that's really a misnomer. Only about 10% of what they do is tied to carrying risk. The majority of their business is managed care for the government, managed Medicare, Medicaid, and corporate accounts in which companies self-insure. And so there's very little insurance risk in this space. It's really a health administrator, if you will. And it's so regulated that they're frankly not allowed to even, the amount of profit they're allowed to make is regulated as well. And you see that between all the companies, there's very limited competition, and call it GDP plus growth, largely tied to the growth in healthcare costs.
We get that one. Let's get to TNET, TriNet. It's also kind of an employee benefits company, right?
Yeah, so this is slightly different. It's a very small company, about a $5 billion market cap. So this is a company that serves small and medium-sized businesses that are looking to get employee benefits. And employee benefits may mean many things, primarily HR, health insurance, disability insurance, etc. But in practice, 90% of what drives their business is health insurance. So what they do is they effectively get a bunch of small employers with small employee numbers. They get them together and, using their bulk purchasing power, acquire health insurance at better rates, pass the savings on to their customers, and keep, of course, a small part of those savings for themselves.
Hey, Lukasz, thanks so much for joining us. Appreciate listening to some of your thoughts there on the stocks that you guys own. Some pretty interesting names, some good performers. Lukasz Tomicki, he's a founder and managing partner of LRT Capital Management, one of those folks who's putting money to work, who, as Tom Keene would say, has the courage to be in the market. S&P 500 pretty much unchanged on the day. NASDAQ off about 0.3%, but at the index level, not a lot happening there. Of course, a lot of movement under the surface there as companies report earnings for the next week or so in size.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Claudia Sahm is the founder of Sahm Consulting. She is obviously a former Federal Reserve economist. We'd love to talk to her both here and on Bloomberg Surveillance. She is also the creator of the Sahm Rule, which is a recession indicator, and a Denison University graduate.
So the Denison, you guys are the fighting?
I'm from Granville, Ohio, right. So for me that's a big deal.
And it's a Denison fighting.
They're the Big Red, I think, is what they're called.
Okay. Very good.
It's not really a sports thing, but
more of a fun school.
It was a fun school. Then it became a very serious school in the 90s when I was living there, although I did see fish there, which was pretty awesome. Claudia joins us to talk about the economy, obviously, and not her college experience. And you also wrote a column, Claudia, about Americans basically, trying to answer the question that we're asking every day, which is, why are the numbers so good and Americans feel like the economy is so bad? 5% GDP, and yet everyone says a recession's around the corner. How's that going to happen?
Right. And to be clear, there's a lot of reasons to be gloomy. Inflation is high. There's a lot of uncertainty. The question is, why are the extra gloominess, right? And things are, as you said, there are a lot of good things. Unemployment is low. It's been low for almost 2 years, under 4%. Like, that's really good. And if you ask people, how's it going? What kind of news have you heard about the economy? It's as bleak as when you go back to the 1970s and early 80s, right? It's very hard to say, oh, that totally makes sense. Like, there's these bad things happening in the economy. It's that extra kick. And frankly, that's the piece we want to understand, because it could really be telling us something bad is around the corner. People have been doing that for 2 years, and then it's like, okay, what else is going on here?
Well, we can't underplay the importance of inflation to a normal American who is living paycheck to paycheck anyway. Economists love to look at core inflation measures, which take out all the stuff that we spend our paycheck on, right? Food is expensive. Right now, cars are incredibly expensive. Plus, financing has climbed. Houses are you don't even want to talk about, because that's not even affordable if you can find one. So is that the main problem that Americans have?
Inflation has always been something that people would get riled up about, rightly so, right? And the price tags are legitimately higher, and they're not coming down. What we've seen this year is it's slowing down. Inflation is coming down. That is a form of relief, and that it could have been a lot worse. And there's lots of different pieces of good news that don't come up. We found out last week that household net worth for the typical family jumped 37% pre-pandemic to last year. And that was across income groups, demographic groups. You just saw these big increases. That matters. Living paycheck to paycheck has been a problem in the U.S. economy for decades. Many people have bigger paychecks, and there's a lot of people who have a little bit of a buffer that have never had it. So it's tough to see all those pieces come together and then have this absolutely bleak outlook for the economy.
Well, Claudia, how much of it is the income inequality, wealth inequality in this country, where the top 10% are doing fine, actually better than fine, but the rest are really struggling with inflation, that type of thing. How much is that to kind of account for it?
This is the rarest of post-recession periods, in that we've seen often the bottom do better than they have coming out of any recession. I mean, the top's always going to be fine, right? Wealth inequality, income inequality has been a problem in the United States for decades and decades. We actually saw some compression of that inequality, so it's shrinking some. I mean, you can't hardly see it on the graph, right? It's still big. So that inequality is out there. People tend to focus on what's in front of them, like what they need to do to put food on the table, roof over their head. And there are some surveys, if you ask people about their own finances, they're more upbeat than when they look out at the economy. And so that's why I've written 2 pieces now at Bloomberg about this extra pessimism, trying to explore what it could be. And often it points to things that go beyond the economy, because we're asking people big picture about their outlook. And there are other factors at play. We went through COVID, and the war in Ukraine is ongoing. We've had so much bad news since the pandemic began. And then we do have features of how we transmit that bad news out into the public. And that's something that's different than the 1970s.
Yeah, social media is what I assume what you're talking about here.
Yes.
And I think we all know now that the way for Elon Musk and Mark Zuckerberg to make money is for people to get angry and hateful on social media that drives engagement and, at the end of the day, the bottom line. So it kind of amplifies everything that's bad, doesn't it?
Right. And we've always had the case that bad events happen. The news comes out, it has a bias towards the bad. There's research, news organizations, right? It's more negative. If it bleeds, it leads. Right. So this is not new. But what happens is once it gets on platforms, social media platforms, it can spread far and wide and really fast. So it makes this bad news very personal because it can be conveyed by real people and not necessarily print media or, on the TV. And it absolutely is the case that not only does negative spread faster, it gets absorbed like there's a human tendency towards the negative. So it's like you put these three factors together, really bad events, news has a bias towards the negative, people love the negative, and then we can spread it really fast. So that's one way to think about it, that you could get this extra kick. But absolutely, we talked about a lot of economic factors that may not be captured, may be different in the past. That could be in there too. So it's really important to kind of pull this apart and figure out what's going on, because if people are really downbeat, it can create a self-fulfilling prophecy in that they pull back and they get more downbeat. And then before we know it, we're in a recession. So this is an important question. People could be right. I mean, we could really be in a bad place in the next year or two.
Well, and a lot of times when we get into a bad place, our leaders will hopefully come together and pull us out of it. And currently doesn't look like that's a possibility. In this climate in Washington with, the lack of any kind of bipartisan. In fact, you'll be thrown out as Speaker of the House if you reach across the aisle to make a deal. And deficits continue to climb. Now the latest the latest look is about $2 trillion. Does that affect people's outlook? I mean, you say they're doing well at home, but they're gloomy about the economy. Could it be because they see, the USA government train kind of running off the tracks?
In some of these sentiment surveys, they ask people about government economic policy. It probably doesn't surprise anyone that the government scores pretty low and has for some time. It's not clear to me that that's changed dramatically. You see it do move in debt ceiling moments in the past, where people get more negative. It's more of that reality, what happens if we were to go into a recession. Typically, there's a saying, we're all Keynesians in a foxhole. So the money would go out, the stimulus checks have gone out. But what would be problematic is if it were a severe recession. I mean, we will hopefully never see anything like COVID again, is that it wouldn't last real long. And that ends up hurting people at the bottom the most, right? Because they probably aren't recovered right away. So a government that doesn't have it all together will cause problems for people. I mean, real people are going to suffer in the case of an economy going down.
So where are you right now, Claudia, with your economic outlook?
It's tough. I wrote some on my Substack last week, really we got to celebrate the wins here. We've seen inflation come down pretty notably, whether you're looking at core or
Cheer
total
up,
inflation.
Guys.
Yeah, I mean, I tried to hey, there's some good stuff out here, knowing that this wasn't going to amplify through social media. It's kind of hopeless. But there are plenty of dark clouds on the horizon. Interest rates are up. They've gone up a lot. And you are starting to see it when you ask businesses with their investment plans, in some of the consumer credit quality measures, like the delinquencies. They fell after the pandemic, because again, we gave people so much relief. They're moving up. And we could be moving back to quote unquote normal, where there's just a certain level, or this could be a sign that it's getting, people are in a more precarious place. And yet, we've been kind of saying that at different times over the last 2 years, right? The recession is always coming, and it will someday. We don't escape these over the long term, but things have been better than we thought, or people were saying, or businesses were saying. So we could still balance it out, moderate some things, and keep going. But it's not what should happen. right? What should happen is that we go into a recession. That's not my base case, but I know that's the reality of everything that's lined up.
All right, Claudia, thanks so much for joining us. Always appreciate getting a few minutes of your time. Claudia Sahm, founder and independent economist at Sahm Consulting.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.